This is Andrew Stotz of Stotz Investment Research, and we're going to do some valuation masterclass work. So let's get into it. First, my question is this company's restructuring enough to close the tech gap with Tesla? What company is this that I'm talking about? Let's look at it. This is Andrew Stotz of Stotz Investment Research. Welcome to Valuation Masterclass Case Study today. For those people watching it on video, welcome. You're going to have a lot of slides and charts that you're going to be able to see my valuation here. But for those people that are listening in, you'll be able to go to the website, valuationmasterclass.com, go to the blog. I'll have the link. And from that, you can download the pitch deck of what this is. So this is where I make an independent assessment of hot stocks or interesting stocks and their valuations. Today's company is, well, Daimler AG. Let's look at Daimler. So this video is for learning purposes only. This is not investment advice, and it's not a recommendation. My name is Andrew, and this is Ask a John Andrew in the Valuation Masterclass. So let's look at Daimler first. It's a pure play spinoff that could bring profitability back on track. Now we can see that the share price has been continually rising since the worst of the recent crisis, which bottomed out in March 2020. So there's three things that I want you to know about this company. The first thing to know about this company is that planned restructuring to turn around profitability and value. That's what they're doing. Accelerated electrification is necessary to stay competitive, and strategic partnerships to bring autonomous driving forward faster. So if you've got any questions, put them in the chat. I see some people in the chat right now. I see Ivan J. Mandela. Ivan, nice to see you. And if you have any questions, make sure to put them in the chat. Okay, so now let's go back and let's continue on. And there's some key statistics that we can look at. There's about 28 analysts covering the company, and the upside, the target price is about 100 euros. You can see on the chart that the blue line shows the company's share price, which right now is at about 90 on the left-hand scale there. The next statistic is the PE ratio is, my goodness, 5 times, very low. And dividend yield of 1.5. I think it looks interesting. High motion, nice to see you. So let's continue. First, let's talk about sales. One of the most important things we need to look at when we're valuing any company. So let's look at breakdown by segment. Cars and vans are 50%. And of course, Mercedes-Benz, AMG, Maybach, and others. And then we have trucks and buses. And that is Mercedes, Freightliner, and the rest. And then we have financial services, where they have banks and financing services for their vehicles, which accounts for about 17%. So let's look at the story, because that's what investing is all about, finding the story and investing in it. So number one, planned restructuring to turn around profitability and value. So today, Daimler is Mercedes-Benz, Daimler Truck, and Daimler Mobility, which we just saw. But what's happened is the shareholders have confirmed a restructuring plan that's taking effect in 2022, and they're renaming Daimler AG to Mercedes-Benz AG, and they're spinning off its truck and buses segment. So in the future, it's going to be two companies, Mercedes-Benz and Daimler. Existing shareholders will hold 65% of the newly listed spin-off entity, and the share price responded positively with this result. Hopefully, by separating the units, they can get more focus in each of the units. So, since this is a lesson, let's talk about what's an equity spinoff. So the answer to that is, well, an equity spinoff is when a company decides to create a new listed entity out of its existing operating business. So it's got a division within its company, and it decides it's going to spin it off and list it. The newly created shares are distributed to the existing shareholders, unlike in a carve-out where the company sells its shares in an IPO and it raises capital. The idea is that two independent companies are worth more than one signal entity. Now, one of my lessons I've learned over the years is that when a company is small, bringing companies together can add value because it makes the market capitalization and the liquidity of the company bigger. But when a company gets very big, sometimes splitting them brings more value. So the objective is to turn around falling profitability. Here, I've produced a chart of ROIC and net operating profit after taxes. And what we can see is under its current business structure, Daimler was not creating any value. Just look at that ROIC. Basically, that ROIC was going from 6 to 4.3 to 3.7, and then most recently down to 2.6. Now, you can say 2.6 in 2020, it was a bad year. So let's just say that they've been at about 4% return on invested capital. And with the spinoff, the separate entities can now focus on enhancing efficiency and profitability. Of course, you might ask the question, well, why aren't they doing that now, right? Why does a spinoff make any difference? Well, hopefully it allows them to focus and not be overwhelmed. We'll see. But they've got to really turn around that return on invested capital. Let's look at what the company actually announces. What the company shows is that Daimler has not added value to its shareholders. In 2020, you can see that they're saying that the Mercedes-Benz car and van unit had 1,239 million euros of value added, but Daimler trucks and buses minus 600, Daimler mobility minus 300. So you can see from a divisional perspective where the weaknesses lie. And I guess if you separate them out and bring them out as separate companies, you may see that they can make a difference there. So Daimler uses value added as the most important performance measure. This is from page 43 of the annual report, where they say value added shows the extent to which the group and its divisions achieve or exceed the return requirements of the investors, thus creating additional value. So again, ask John Andrew, this is teaching and learning. How likely is a successful turnaround? Well, this is a chart that I produced from a study that we did a long time ago. And basically what we did is we grouped companies. I'm just going to grab my pen here and I'm going to draw into this to say that we grouped companies into categories. One group was the stars, which was high return on invested capital, and the other group was the dogs, which was low return on invested capital. And then we tracked their performance over 10 years. And what did we find? Stars fell, but they didn't go down to the average. And dogs rose, but they didn't go up to the average. In fact, they didn't even go close to the average, even took 10 years. So the answer from my perspective of this is that I would be very skeptical of a turnaround. Now, you can say because they split it off, they'll have different leaders running it. Now they can really do what they wanted to do. Possible. But generally, I would say be skeptical about turnarounds. Unless the management or the ownership has changed, that can be a very different situation. So that's one thing to look into a little bit more. Number two, accelerated electrification, necessary to stay competitive. So here you can see the number of cars, electrical vehicles sold globally, and it was big jump so far in 2021, and market share of total cars is expanding. So we can see that the demand for electrical vehicles is growing exponentially. And it's up 160% in first half year on year. And sales were as high as the total year of 2020, just from first half. And here we can see market share in total units, Tesla at the top, VW, GM, and then all the way down, you'll see Daimler at 4.8 all the way to the right. So Daimler reduced the battery EV in its attempt to catch up with its competitors. So it's just launching and it's at 4.8. So hopefully the company can really catch up. The objective is to provide all electric vehicle alternatives for every existing car model by 2025. So now the next one is strategic partnerships to bring autonomous driving forward. The company in 2020 entered a strategic partnership with NVIDIA, the world's largest maker of AI chips. And their chips are really the most advanced, and they're in cars across the world. From 2024 onward, the company will roll out a fleet with fully automated driving functions. Now, you can download today's slide deck. If you're listening in, you can download today's slide deck. If you're watching, just go to valuationmasterclass.com, then go to the blog section, and you'll see it in there. or you can scan the QR code that I'm showing for those that are watching the video. So the FVMR scorecard is the next thing I like to look at. It measures the stock's attractiveness relative to stocks in that country or region. Attractiveness is based upon 4 elements. That's fundamentals, valuation, momentum, and risk. And the score is from 1 to 10. 1 is best, 10 is worst. So here you can see the scorecard that we use, and this goes into fundamentals, valuation, momentum, and risk. At the top, you can see the valuation, that the composite of these factors tells me that it's kind of neutral, meaning I'm not that excited to jump into this kind of a stock right now. However, what we can see is valuation looks like it's best. In other words, it's attractive. So let's look into that with a little bit more detail with our little magnifying glass. And here it is. What we can see is the company has price to sales of 0.4, PE down to 5, price to book. I like to look at price to book in this case because there's so much volatility in earnings. And you can see a PE of 15.9 in December of 2020. That 15.9 is probably not that real because earnings just collapsed. And so with earnings collapsing, then the PE rises. But you can see that the price to book is probably a better measure for that. So I think on most measures, you can say this stock is relatively cheap. And what you can also say, though, is that it may not go back to, it may not get that expensive. Look, you can see in the past, it's been at 1.2 price to book on a PE ratio. Besides the 15.9 of December 20, it was at a high of about 7.5 times PE in 2017 and 2018. So 5 times PE and a 1 times price to book is a little bit cheap. And if they can increase their profitability, it would be great. Now let's look at valuation to try to understand what's going on. So consensus, let's look at consensus first because we have 28 analysts. They remain bullish on the restructuring decision. So here I tried to look at a ranking of the analyst recommendations. And what we can see is that 10 of them are strong buy, 15 are buy, and 3 are hold. There's no sells or strong sells, but of course, that's pretty much the case in most cases where analysts are almost always optimistic. The median and mean price, target price of the analyst is about $100. So really the question we have to ask, the stock's trading at a little bit over, I think, $80, and we're saying that the consensus says it's worth about 100. So we have to make a decision. Is this worth what the consensus is saying? So there's 28 analysts covering the company. The upside is about 15% at the 100 mark. And let's see analyst forecasts. We can see forecasts for the next 3 years. The revenue growth forecast for 2021 is 9.7, 12.3 in 2022, and then 23 is negative. And I think that's because they're accounting for the spinoff there. What people are expecting is that margin's going to improve. The net profit margin of the company back in 2008 was 4.3. Then it went down to 1.4. Then it went up to 2.4 in 2020, which remember was a tough year. And analyst expectation is a margin of 7.5, a crazy high bounce back that happens in 2021 if things go according to what analysts think. And then analysts are saying it's going to come down to about 6.8, 6.9 net profit. So we can see a little bit by looking at the P&L. For those viewers out there, you can see the P&L, but for others, you can just see that the pandemic in 2020 has disrupted car sales, leading to a severe drop in revenue. Revenue went from 167 billion euros in 2018 down to 154 billion euros in 2020. Falling profitability has resulted in a low bottom line right now. It's been flat for the last 2 years. Now, I'm now looking at the balance sheet and looking at the current and long-term assets. And what I can see is that the company has a solid cash position, holding around 10% of its assets in cash. And the spinoff happening, the balance sheet in 2022 will decline by the amount of the assets that belong to the truck segment that's lumped in there. And then what will happen is that it'll switch that into long-term investments, which is going to be where they hold that 35% of the company. So let's look at liabilities for a moment. The company's relatively highly leveraged with a debt to equity ratio of about 78%. Okay, what about cash flow? And now I'm looking at the cash flow statement, and there's been a big jump in operating cash flow. In 2018, it was 343. In 2019, it was 788, 7888, and then in 2020, it was at 22332. So a massive jump. But we can see that volatile operating cash flows were not able to cover the investment activities in both 2018 and 2019. And operating cash flows was boosted by falling accounts receivable, inventories, and other assets, not from net income. So 2020 saw a strong operating cash flow only because of the management of the balance sheet. Now we expect high capex for the future as the company needs to catch up in electrical vehicles to compete with Tesla, BMW, and VW. So there is going to be a lot of expenditure on capex. We can see the net profit margin in 2018 was at 4.3. It went down to 1.4 in 2019. And remember, 2019 wasn't even a crisis year. 2020 was, and it came back up a little bit to 2.4. So demand in the German car industry rebounded in 2020. However, semiconductor shortages have been a constraint on the growth in the short term. And this comprises a drag, and this causes a drag in margin. There's a low ROE of about 5.9% in 2020. And basically the hope is that once they spin off the division, then they'll see their ROEs coming up in both cases. Generally, they get a very low return on assets, about 1.2. I think the average return on assets in companies across the world is about 4.4. I see Mark Decker there. Hi, Mark. Now, its profitability is still far below competitors, though. That's what I can say. Its closest competitor in the truck segment is Volvo, and they have 2 times higher net profit margin. And Daimler's spinoff could lead to a convergence in margin. So let's look at my favorite chart here, my favorite table. This is the free cash flow table. Remember, free cash flow is the EBIT. Then we adjust it into NOPAT. Then we take away, or we add back depreciation, and then we take away CapEx, and we take away working capital. And what we can see from this is that tax bill has risen. The taxes for the company were 30% in 2018, and now they're up to 42%. So a pretty large chunk coming out in taxes. Then free cash flow turned positive in 2020. But remember, that's driven mainly by the management of the inventory. Of course, we'll take it any way that you can increase free cash flow, but this we can see is driven mainly by that. Hopefully in 2021, the company can really get its profitability back. But of course, when you have a tax rate that's gone from 30 to 42, you've got to get a lot of profitability back to get your NOPAT back. Remember that a company's value is based upon the free cash flows forecasted out and then discounted back. So high investment expenditures require a consistent generation of strong operating cash flows. So let's look at our forecast assumptions. So consensus for revenue is about 7.1. I'm going to pick 5 just to be conservative. Consensus for gross margin is about 22. I'm going to pick 21.7. EBIT consensus is about 10%, and I'm going to pick about 9. And net margin is 7.1, and I'm going to pick about 6.3. Part of what we're doing here is we're trying to test consensus and see what they're saying. So I'm going to take a little bit more of a conservative stance relative to consensus, but not that conservative, right? German car sales is likely to see a strong rebound over the next 3 years. However, it takes time until the profitability converges to the industry average. Spin-off decision, is likely not to lead to immediate effects, and maybe analysts are overly optimistic on that. So here, from my valuation, I can say bearish case is about 90, base case is about 95 euros per share, and bullish case is about 100 or 99.7. So I would say that from a valuation perspective, what I can see on this company is that analysts are a little bit optimistic, but I wouldn't say that it's a big problem considering that stock's trading just about at book value. So if they could give us some good surprises, then it would be interesting. Let's look at the world-class benchmarking scorecard, where I identify a company's competitive position relative to its global peers. The combined composite rank of profitability and growth I call profitable growth. And we want to see companies that are number 1 that are getting a 1. And so what we can see here is that profitability is ranked at a 5. Now, what that means is I'm comparing against 1,000 large consumer discretionary companies. I'm not just comparing against other automakers. So I compare all companies against a universe of its sector. And here we can see that profitability, in this case, which is ROA, has gone from 8, which is a below average ranking, to 7, which is still a below average ranking, to 5, which is now an average ranking. So the point is profitability is improving. And what we can see on the growth side is that growth ranking from 1 to 10 in the past 12 months, PTM, we can see that that's gone to a 2 from a 6 in 2020. That's an improvement. So the improvement in profitability relative to global companies and the improvement in growth relative to global companies has got the profitable growth ranking going from 8 to 7 to 4 right here. And this type of movement from 8 to 7 to 4 is a type of thing that does tend to drive share prices in my back testing of this tool. So if they could keep this up and get to a 3 or a 2 or a 1, then we really could see the share price fly. So let's continue on. Let's talk about risks. So the key risk is to keep up with technology right now. Ongoing supply chain disruptions create shortages like semiconductors and increase production costs. Also, failure to keep up with technology changes could result in a loss of market share, and labor shortages of specialist employees creates competition among car manufacturers. Those are the main risks that I see. So let's go back to where we started. Daimler is a pure play spinoff that could bring profitability back on track. And if they surprise on the upside, this stock is damn cheap at 5 times PE. The planned restructuring to turn around profitability in value, that's the idea. And their other thing is having accelerated electrification necessary to stay competitive. And the third thing is strategic partnerships to bring an autonomous driving forward. So the conclusion, let's wrap it up. The conclusion is the spinoff momentum might already be priced in. They're going to need, because the analysts are already at 100 or so on their target price. So the company's going to need to really deliver on that. And if they could, that could give us some upside. But it could take a long time to close that profitability gap. It's not that easy. It's probably the same people running each division as it is the same people who are running them, whether they're within the company or whether they're separate. And finally, analysts forecast drastic changes in fundamentals too early. I think it's going to take some time. So the question is this company's restructuring enough to close the gap, the tech gap with Tesla? And my answer to that is probably not. What do you think? I'm going to close that presentation there for a moment, and I'm going to come back up on the screen. I want to thank you for listening to the Valuation Master Class case study. The company is Daimler, and you can see that it looks interesting. It's not that expensive. Analysts aren't crazy optimistic. So if they can deliver, it's an interesting company. If you have any questions, if you want to get the download of the actual PowerPoint, just go to the link that's in the show notes, and I'll see you there. Have a great day and have a great weekend.